we're going to be in a bust, which means something far worse than just a normal recession. It'll mean a financial crisis with banks failing across the globe. That will force their hand, and ultimately they'll start with, trillions, maybe 2 or 3 trillion, and realize that's not enough and go to 5, and then that's not enough. And ultimately, my expectation is we will see 20 trillion in new QE.
You're watching CapitalCosm. My name is Danny. It is August 20th, 2025, and my guest today is David Hunter, who I'm thrilled to have back on the show. David, thank you so much for coming on, my friend.
Yeah, hi, Danny. Great to see you.
Yeah, likewise. It's always a pleasure having you on, David. Let's just dive into the nitty-gritty. What is most prominent on your radar screen right now? What should be on the radar screen for investors out there? So many things going on. The gold price, yields, so much uncertainty. Where do you want to start here?
Yeah, so let's start with the market. I mean, the market is as I've been saying for a long time, we're in a melt up, heading for a 43-year top. Last time I was on with you, the market was down 20%, and everybody was getting bearish back in April. I talked about the tariffs back then and said, people are overreacting. There's a lot of it is negotiation, and you got to let the dust settle, let this play out. And that I actually raised targets back then. So when everybody else was lowering targets and getting bearish, I was getting more bullish, and it's played out. Obviously, we're at new highs. And so I think the real story out there is that we're still in this final leg of a 43-year secular bull market, and that there's a lot of upside here between now and the end of the year. So I think we're in a historic rally. I think it's going to go parabolic. We're in a correction right now, and I would not be surprised if we see the S&P back to 6,100, maybe even back to 6,000. I wouldn't be surprised to see the NASDAQ down 8 to 10% from its recent high. So we're looking at a historic market, but it's not ever straight up. There's going to be a period of consolidation always. So that's a worst case for me. NASDAQ 10%, S&P 8%, and it's probably going to be. It could very well be less than that. Could be half that. So you just have to kind of let this little sell-off, this little correction play out. And then I think after that, we could see the parabolic where it goes almost vertical and covers an awful lot of ground in a hurry. My targets, and I raised them in my most recent letter. So my targets are S&P 8,700, NASDAQ 30,000, the Dow 60,000. And the Russell 2000 I have raised up from 3,300 to 3,400. If you do the calculus on those, I'm talking 35 to better than 50% from here in the markets. And I'm saying, doesn't have to, but I'm saying there's a very good likelihood that we complete this run this year. So that's a hell of a historic run if we see those kind of targets met this year. But the point is whether I hit them right on, or whether they come short of that, or whether they take longer to get to my highs. We're in a final leg of a 43-year secular bull market. Nothing like this has ever happened. And I think people, particularly the institutions, have sold this market short. They continue to be skeptical. You get these little sell-offs and people get more bearish. So I think what we're talking about here is as investors, don't get too caught up in the short-term sell-off, because I think it's an opportunity before it goes a lot higher here. The irony is we're close to a 43-year top, and normally if you can get close to that within 3, 4, 6 months, it makes sense to take money off the table, because the other side of the mountain is coming after that top, and the other side of the mountain, I think, is going to be uh, probably the worst bear market we've had since the 29 crash. So, so clearly, normally you would be at this point getting more cautious. But the irony here is that we're looking at returns, if I'm right, of 35 to 50% or more in less than 6 months. Um, that's years of returns normally. So it makes it tricky. You do have to be aware that we're moving to the end of this, and it's been a fantastic run. But you also have to be aware that getting out here or getting out too soon, you may panic and get back in at the top because it's going to, we're not going to be at the top for no reason. Everybody's going to be bullish. There's going to be a story why you don't want to get out. That's going to be the hard time to sell, not now. It's easy for people to get bearish now because they think it's near a top and they see problems ahead in terms of the economy and inflation, et cetera. At the top, the story is going to be the Fed's on board. There, we got tailwinds from the Fed easing. This cycle looks like it has legs for another 2 or 3 years. The Trump policies are working, et cetera. Just be aware that's when you have to be kind of look at yourself and say, maybe I'm getting too greedy. Down here, it's easy to get caught up in the bearishness, particularly when you get a day like today. I would just caution people. There's a lot of upside ahead.
And how do you arrive at these figures, David? Because I mean, we're not necessarily the figures, but just the call that we are in one final leg. How do we know that we won't just keep going up more, keep going up nominally in the stock market as QT comes to an end and the potential return of QE? We may see in real terms the stock market go down, but how can we be so sure in terms of a nominal
Nominal.
basis? Yeah, that it keeps
Yeah.
going.
So it's a forecast. Obviously, I don't know, but I've been pretty accurate here for the last 5 years in terms of or more, in terms of calling. I was bullish at the bottom of the pandemic. In March of 2020, had a target then when the Dow or the S&P was down at 2,200. I had a target of 4,000. I've been raising it ever since. People criticize me because my targets have gone from 4,000 to 4,800 to 5,300 to 6,000 to 7,000 to 7,500, and now to 8,000 and now 8,700. And they say you're just a moving target. No, I just stayed bullish because the fundamentals were there. My analysis said this thing's got legs. That's how you forecast. You can't know at the bottom exactly where it tops out. At this point, my concern is there are fundamental reasons to get bearish in the not too distant future, because I think the economy is going to run into trouble. It's slowing down. It may be in recession already. If you look at some of the ISMs and things like that, they're showing signs that we're rolling over. A lot of leading indicators that would normally tell you that there's trouble ahead are signaling that. I think the Fed's been too restrictive, and it doesn't necessarily show up right away, but there are signs that that restriction is going to lead to a recession if we're not already in one. And the problem is, we have 330 trillion in global debt out there, quadrillions in notional value of derivatives. That's massive leverage, far more leverage than we had going into 2008. And my concern is it will turn a normal, ordinary recession into something far worse, what I call a global bust. So, and I think that's coming as soon as next year, which means with the market being a leading indicator, something that leads those things, it just means time wise, we're probably, late in the game.
And are we still looking at an 80% crash from the top?
I am, yes. That's my guess is that we're going to see, like I said, the worst since 1929. Peak to trough, I think we could see 80%. Now, do I know it's 80? No. Could it be 70? Yes. But I think it's going to be the worst bear market we've had in the post-World War II era.
And how do you think we react in terms of the government? How do you anticipate the Fed reacting? How do you anticipate the White House reacting in that kind of scenario?
Yeah, as I say, probably the easiest part of my forecast if I'm right about a bust, is how the policymakers react, because it's human nature. They won't have a choice. I think they're going to react slowly first, because they don't want to repeat what everybody thought was a mistake in 2008-9 in terms of far too much QE, far too much bringing interest rates down to zero. Powell has been very vocal about not wanting to go back there and saying we won't repeat those mistakes. So when it's most needed that they do go back to that policy, they're going to be dragging their feet and saying, we can't do that. We know what happened last time. But ultimately, as things get worse and they're too slow in reacting, they'll react, but they won't react with nearly enough response. That means things will continue to free fall. We're going to be in a bust, which means something far worse than just a normal recession. It'll mean a financial crisis with banks failing across the globe. That will force their hand, and ultimately they'll start with, trillions, maybe 2 or 3 trillion, and realize that's not enough, and go to 5, and then that's not enough. And ultimately, my expectation is we will see 20 trillion in new QE. So the balance sheet of the Fed will expand from, its current under 7, maybe 6. It'll expand to almost 30 trillion. And that's because there's lags to it, they won't know that they've done enough. So they'll keep doing more. And ultimately, I think you could see the balance sheet expand. It got up to 9 trillion post pandemic, right? We put 5 trillion in. This time around, I think we're going to do 4 times that, 20 trillion. And that's just seat of the pants gas, whether it's 18 or 25, I don't know. But we're going to see QE like we've never seen before. It's going to be accompanied by, new debt and all kinds of programs out of the government to try to stabilize things, turn things around, just like we saw post-pandemic, just bigger, and just like we saw in 2008-9, but bigger. And basically we're at that extreme wherever, if you go back and track this from the Great Depression, we're in a super cycle that's nearing the last decade, is in its last decade. Every cycle, every up and then every recession, and the response to those recessions, everyone pretty much along the way has gotten more severe. So you've had bigger excesses on the way up, and then bigger tightening on the way down, leading to even bigger excesses in the next cycle. And it's somebody described it as a buggy whip type of phenomena where it just gets bigger and bigger each time. We're now at max excesses where, first of all, it pushes things up to excesses beyond belief in terms of the markets, and then cranks down to a bigger decline than we saw in 2008-9, requiring more liquidity and more response, and because of the leads and lags, leading to even bigger excesses. So we might even see, my guess is by the time we get to the end of the next cycle, the one that follows the bust, we might even have debt at, we're at 330 now, we might be at 450 or 500 trillion in debt worldwide. And we might be, and it's going to be happening in an inflationary environment where they have to respond to that. So, but basically the reason I think we're nearing the end and why it can't go for another 2 or 3 years is because a lot of the response of the last year or two, where I think the Fed has over responded, it's just beginning to show up that they have gone too far. We had so much money pumped in 2020 and 21. That money's been working through the system. So the normal tightening response didn't stop things. The market extended, the cycle extended for 2 or 3 more years because of that unprecedented amount of liquidity in the system. That's starting to disappear. Certainly the repo, the Fed's repo mechanism is down to where they almost have none left in that kind of liquidity pocket. So that's a sign that you're kind of reaching the end of that excess liquidity we've had this past cycle, and interest rates are too high. They are far above market rates right now. The Fed is at 4.25. and they probably should be closer to 3.
Yeah. So let's take a look at some of these yield curves. Okay. So we have the 10-year yield here in orange, and then the other line or the other chart is the 30-year yield. You'll notice that we were moving in tandem for the most part up until sometime earlier this year. Now there's been a divergence. The 10-year yield in orange has been moving pretty much sideways. The 30-year has been moving a little upward towards the upward direction. What does that mean when the 30-year yield begins to overtake the 10-year yield? Obviously, that means that's the 30-year is more undesirable relative to the 10-year yield. What's the ramifications of something like that?
Yeah, well, frankly, in a normal yield curve, you would have 30-year rates higher than 10-year. It's obviously higher risk. It's longer duration. So that's not unusual. But it is a consensus view out there that the long end of the curve is rates are going to be going up, not down. Everybody's worried about a lot of refinancing that has to be done because rates were very low and then they went higher over the last few years. So you're coming upon a period where refinancing is going to be you have a big supply of treasuries. You're going to have more need for refinancing in the corporate sector, et cetera. And there's this view that we're at the low end of inflation and that's going to start moving up. That is not my view. I think you're going to see all rates come down, and I think we're very close to that turning point where I think you're going to see us move towards the bust. And like I said, we may be in recession already when they go back and backdate it. I believe the 10-year over the course of the balance of this year could move towards 3%, if not below it. I believe the 30-year will lag that by some, but it's coming down as well. And short rates will be even lower. Part of that is the Fed easing, but part of it is just the market recognizing the economy is slowing and inflation is not the risk. Jobs are becoming harder to get, et cetera. We're going to start seeing that, I think, this fall. So the Fed is behind the curve. The Fed will have to catch up over the course of the next 6 or 9 months. Ultimately, in the bust, which is really next year's story, I think you could see a 0% 10-year and a 0.5% 30-year, if not lower. And short rates in the negative territory. The reason for that is a very weak economy, as I said, global bust, and a Fed, along with every central bank out there, but a Fed, in our case, buying up every treasury in sight. That's how you create QE. So there'll be, those people out there, and it's a consensus, who believe that there's going to be an excess supply of bonds and not enough buyers, particularly foreign buyers, but other than the Fed, are underestimating how much the Fed's not going to be able to find all the bonds they need. They will find them because the Treasury will be creating new debt. But ultimately, I think the problem is not excess supply. The issue will be, there's not enough supply to get as much money out there as they want. So they'll be creating it. But so I'm obviously in a very contrary camp from where most people are, but I am not one of those worried that, or in that camp that thinks rates are the long end of the curve is going up, even if the Fed eases. Part of that is obviously recency bias. What happened last fall? The Fed cut, and yet the long bond went up in yield. So there's, people remember that, and they're worried about that again because, as you show, the 30-year has been pretty sticky up here. But I think that's going to change here over the next several months.
Hey guys, quick pause from the podcast, but this is something I feel is really important to let you in on. Back in 2020, before I even started this channel, I was looking for an edge, a way to find the big opportunities most investors never even hear about. That's when I found Capitalist Exploits Insider. From day one, it felt like I suddenly had my own team of world-class market pros working for me, digging up trades all over the world, doing the deep research, and handing me ideas that had massive asymmetric upside. Stuff that I would never even think about. Since then, my gains with them have blown past the S&P and the NASDAQ, and it's honestly the single best newsletter I've ever subscribed to. And that's not me blowing smoke. That's for real. I've interviewed their publisher, Chris McIntosh, more times than I can count. In fact, my latest conversation with him is linked in the description box down below if you want to check that out, as well as a pinned comment. And every time, I'm reminded why I've stayed a member for years. Right now, they're offering a special $1,000 discount on the Insider subscription, but it's only for CapitalCosm viewers, so you're only going to get it by clicking the link down below in the description box or the pinned comment. You're not going to find this anywhere else. Click the link, lock it in, and start getting the same game-changing research I've been using since 2020. Yeah, well, what does that mean, though, when, as we can see here, you've got the Fed funds rate in orange, and then you've got the 10-year yields on the other chart. When we cut here in August, you can see the Fed fund rate go down, but the 10-year held relatively steadily. And if you look at this thing from a very long-term view, you'll notice that the 10-year often leads the Fed funds rate. The market kind of sniffs out what the Fed's going to do before the Fed does. This time around, there wasn't any indication. Well, I guess you could say it was right here, right? It's when the 10-year plummeted a few months before the August cut. But yeah, go ahead.
Where are we? Is that on the chart? Is that now or is that back last August?
No, this is now. This is up to date.
Now. Well, so the Fed hasn't cut yet. The Fed is cutting, most likely going to cut in September, probably a quarter, but who knows? And I think between now and then, the 10-year is coming down. I think rate declines are imminent. I think you had a backup in rates that is all over. I am not in that camp that thinks rates are going up. I am in the camp that thinks rates are imminently close to rolling over. And that's exactly right. I've made the case, in fact, that it doesn't matter what the Fed does in September, rates are coming down anyway, because the bond market, sets rates, not the Fed. So if the Fed cuts, it only helps the case. But I'm not in the camp that watches the Fed and says, "Oh, what are they going to, their implication for the bond market?" I think we're in a situation where inflation's pretty much contained, under 3%, 2.5%, 3%. And if you look at places, models like Trueflation's model, they're actually below 2. But because the CPI and the other measures that the government follows do not really account for the slowing in housing that we've seen. So, housing or rental inflation. So I think ultimately inflation is coming down and is pretty much contained here, and the economy is slowing and may already be in recession. So to me, rates are about to roll over, and they're, yes, the street pays attention to the Fed a lot more than I do in terms of determining rates. So they may be waiting on, Powell's speech this Friday. They may be waiting on the Fed meeting in September. But ultimately, I think the market's going to lead the Fed.
Okay. Well, speaking of consolidation, there's another asset that's been consolidating lately, and that is the price of gold. What's your overall take on the gold price here?
Yeah, I am very bullish gold here. I raised my target. I don't think it was this letter, but a few letters back, a few quarters back, I raised my target to 4,000 from 3,400. And I think we're going to see that potentially by the end of this year. You're in a consolidation here. You had a great run from 2,500, I guess, to 3,500, almost 1,000-point run there. You're in a short-term consolidation here of the last few months, and I think we come out of that to the upside and have another leg up. So I think between now and the end of the year, you could see 4,000, and I think any consolidation we've had has pretty much run its course now. I think we're right at that focal point. We're going to see this thing start rallying, and the same with silver. I think silver. It's not as clear a chart, but I think silver is on its way higher. It's obviously had a run in very short term, has been kind of back and forth here, but I think you're probably next stop looking at the mid 40s, And
Hmm.
ultimately, I have a target of 75. And that also could happen by the end of this year. It doesn't have to. It could spill over into next year, but I think we're on our way to 75. And then in the bust, both gold and silver will get hit. Silver probably harder than gold, but they could be hit pretty hard because a deflationary bust, and that's what it, in my opinion, will be, is a deflationary bust. We haven't had a true deflation in this country since the 1930s. We've had little bits of deflation technically in recessions, but this will be a true deflation. First in since the Great Depression, that will hit pretty much all assets except maybe treasuries and some very stable things, but I think it'll hit the metals. So gold could go if 4,000 is the top, and obviously it could be something different than that. But if I'm right about 4,000, you might see it back to 2,500.
Hmm.
Certainly back to 3,000 or below. If silver could go, if 75 is the top, that might come all the way back to 30 or below. You're looking at big hits in these things. So just know, investors need to know that we're in a longer term secular bull market in the metals. My target for the early 30s is gold 20,000, silver 500. So there's a lot of upside, but there's this pocket in the bust where you're not going to probably want to buy and hold. You're not going to want to sit there at 4,000 in gold and say, yeah, but I'm waiting for 20,000, because you're going to be very disappointed for a year probably, or 9 months, as it goes through a big correction. Same thing with silver.
But if you're an investor that's not looking to trade in and out, I mean, you're still looking at some very long-term upside nonetheless, right?
For sure. It's just I'm a contrarian and I know sentiment better than anybody, and I know how investors work, and they can sit there at 4,000 and say I'm a long term holder. I'm not worried about short term interruption. I have big upside. When you're in the midst of the bust and this thing has fallen, 30 or 40% or maybe 50%, you're going to be less sure about that upside. You're going to have a different story than you have at 4,000. And more so with silver. If silver goes from 75 to 25, for example, it's a 66% decline. You're not going to be saying, oh, yeah, but I know it's going to 500. You're going to be scared that it's going to, 15. So I just tell people it's kind of like standing on the north rim of the Grand Canyon, looking across to the south rim and thinking you can walk straight across. You got this canyon in between that is going to affect your sentiment, and just know yourself. If you're a long-term holder and you say I've weathered that kind of storm before, I just don't even look at it. That's fine. But for most people, if you suffer 50% hit to your portfolio or 50% hit to some of these assets, most people, um, their sentiment changes, their viewpoint changes.
Is there a chance, or I mean, like a real chance, that we see this global bust occur much earlier than scheduled? Based off of your projections, could we see it occur in the next few weeks, next month or two?
I think that's highly unlikely. I have people questioning whether it's going to even happen in 2026. I say 2026 is likely to be when it hits. I don't know that. So, and my history is that things have stretched on me. So people are skeptical. There's nothing on the horizon. Again, a recession, we may be in recession already. You have to go through recession to get to the bust. The bust is just a more severe reaction in terms of how that recession impacts on all that leverage in the financial system, and we start unwinding. I don't see that possibly happening before the fourth quarter, and probably at the very earliest late in the fourth quarter. And then could be first quarter next year. Certainly, I could be wrong, and it stretches, but I think the likelihood is it's a 2026 story.
Interesting. Well, we've talked about various markets, but now I want to get your take on some of these Trump policies that have been on the table for a while now. You have about $8.5 trillion coming due in short-term duration T-bills. How are they going to roll that over at these current rates? They're, as you know, as you can recall, they were financed at near 0% rates under Yellen, but now it's different. I mean, the Fed funds rate is much higher. They're going to be rolled over at a much higher rate. How do you think they kind of square that circle?
Yeah, I mean, short rates, obviously, they'll just keep doing more T bills. What you're talking about, the longer stuff that's rolling over, is at higher rates, of course. But I don't think they're going to have any problem, as I explained before. I think the Fed is in easing mode, probably starting in September. And more importantly, I think the rates are going to be coming down with or without the Fed, because the economy is coming down, because inflation is not what everybody feared it would be. And I don't think that's going to change. I continue to expect, as we move through the balance of the year, the trend in inflation to be down, the trend in the economy to be down. That's positive for bonds. Um, you know, Scott Bessent will mix and match whatever his auctions need to be and whoever he has working on that, to make it work in terms of getting it out there. We have a huge supply of because we've got 37 trillion in treasury debt. We've got a huge supply of constant rollovers and constant auctions. That's been going on, as you know. It's going to continue to go on. I don't think it's any more than what they've already done. And they did it during a rising rate environment over the last several months. I think as rates come down, it makes their job easier. So I just don't think the supply story, as much as that's dominated the bond desks, and the worry that that's going to push rates up, that they don't know how they're going to get all the. I don't think that's the story. I think the story really is a surprise in how much rates are going to drop from here. So with the 10-year at 430, I believe, like I said, over the course of the balance of this year, which is basically 4 more months, I think you could see it down to 3%. If you have a 3% 10-year, that's telling you that those auctions are not causing problems.
Fascinating. Well, how do you, one last thing. I mean, you and I talked about the tariffs a few months ago. Obviously, they're not as big in the news today as they were back then. But how are we seeing the tariffs play out? It looks like from our recent CPI report, they haven't been impacting the CPI yet. You did see a bit of an uptick in the PPI, higher than expected numbers there. Are the tariffs going? Are the price increases going to be manifested through these tariffs, or as indicated by the CPI, not quite? Or is it the case of them having to move from the producers to the consumers? Given the fact you have a higher than expected PPI, could we then expect some inflation down the line as prices move from the producer to the consumer?
Yeah, I'm in the camp that inflation is going to continue coming down despite the tariffs. Um, I think you are going to see some. There's a delayed response. Obviously, some of that's being absorbed by the exporters. Some of that's being absorbed by the companies here that are bringing in the goods. But margins are going to be under pressure, and they can only take so much. The biggest question is, how much can they pass along if the economy is weakening, right? If the consumers are starting to run into trouble, they can want to raise prices, but it may cut off their nose to spite their face. So I don't know the answer to that, how much is going to get passed along, but I think it's going to be limited by the fact that we are in an economy that I think is slowing towards recession. So, um, there's certainly possible that you're going to get a bump up in inflation. That factor is going to be a factor that's pushing inflation up. But there are offsets to that I think people ignore too much. I think oil is in a bear market that's going to continue. I've been probably the bear on oil for the last 3 years. From 130 down, I've been the one person saying it's consistently saying it's going lower, and it's down in the low 60s. I think in the next year's bust, it's going to 30. Between now and then, between now and the end of the year, you certainly could see it in a trading range between low, mid 50s where it got to, a few months ago, and probably the high 60s. But I don't think it's going up a lot, and it could go down, and that helps. I mean, gasoline prices are remarkably in good shape. I mean, they're low. We keep talking about tariffs, but there are other things. Housing prices are coming down. I think grocery prices in general have finally stabilized. I think there's offsets to the tariffs that are going to keep inflation at the very worst not up much from here, and ultimately down as the economy gets weaker. So that's good news. By the way, just to throw in something we have not talked about, we kind of talked about it before we got on the air, but the dollar, I have a very bearish call on the dollar. I've been calling for 82 on the dollar for quite some time. I think that's where we're headed. Probably next stop down in the low 90s. And part of that, people keep saying, how can you get a dollar down like that? Part of that, I think, is going to be the story with rates. Our rates are coming down, as I talked about throughout this call. And as you pointed out to me, rates overseas have been bumping up. Japan certainly seeing rates start to break out. You mentioned to me Spain had a bump up, and the UK rates bumped up this week. So that's a big part of the story, is the relative rates between these currencies is part of why the dollar is going to be going down, not up. And that's another bullish story, I think, for the markets.
Yeah, fascinating stuff here, David. Let's go ahead and wrap things up here. Anything else you want to mention before we sign off?
Let's see. I think just generally, just kind of to extend it out a little bit, if we have this last leg of the stock market and then a global bust that takes us down 80% in the stock market, that is not the end. There are people out there in the Austrian school, particularly, that talk about the Great Reset. And this is not the Great Reset, in my opinion. This is just a violent bear following an amazing long bull run, and a economic crisis and credit crisis as a result of policy. But on the other side of that, because of all that money printed, there is going to be one more cycle up that does provide opportunities. But the opportunities in the new cycle, as always is the case, will be new leadership. So people have to be a little careful that the old leadership that got us here, meaning AI and tech, and up until the recent year, healthcare, the next cycle is going to be, and basically growth stocks in general were big winners in this cycle. The next cycle is going to be an inflation cycle where commodities are big winners. The precious metals are big winners. Oil could go to $500 a barrel. Industrials will probably be winners as we reshore. But what isn't going to be a winner are probably going to be the index funds, the consumer, technology, depending on the technology. Growth stocks will have to face the fact that if inflation goes from deflation, meaning negative inflation next year, to potentially 25% inflation by the early 30s, that means interest rates could go from 0 to potentially 15 or 20%. That is going to hit index funds because of the PE multiple compression. That's going to hit growth stocks because they don't do well in rising interest rates for obvious reasons. They're steady growers that get discounted with a lower interest rate. When rates go up, it's the opposite happening. And so you have to find those sectors where the prices are going through the roof and they're basically earnings are moving up faster than inflation. and they can keep pace with interest rates or outpace interest rates. So there is going to be a great opportunity next cycle, but it's in commodities, not in growth stocks.
Understood. Well, David, where can people find you if they want to see more of your work?
Sure, Danny. I'm on Twitter or X almost every day, replying to people. So my handle there is at Dave H. Contrarian. And I always point out to people, if you're not seeing even though you have followed me, if you're not seeing my posts, because I'm posting dozens a day, it means you're not set up to see my replies, because most of my communication is through replies to other people. I don't do that many original posts. And then I also write a quarterly macro letter that is available by subscription, meaning there's a cost to it. People can direct message me on X if they want details about the letter.
Okay. We'll have the links to your X account down below. So thank you so much for your time, David. It's always a pleasure getting an update from you. So really looking for the next one. We're really looking forward to the next one as well. Guys, if you enjoyed this podcast, drop us a like and comment. Go, David, go in the comment section. If you agreed or disagreed on anything, do let me know. I do, in fact, read the comments, and I will be responding to a number of comments down below. I can't get to all of them, but I'll try my best to get to a few of them for sure. So let me know your thoughts. Subscribe to the channel so you don't miss an episode, and liking, subscribing, commenting, all that stuff goes a long way in helping boost this channel and this message and this video and the algorithm. So much help, much appreciation for all of your help here, guys. And check us out on Substack at CapitalCosm.substack.com to get early access, uncensored versions, and ad-free versions of all of my videos. And with all that said, thank you for watching, and I will catch you later. Bye.
Thanks, Danny.